To hedge or not to hedge? That is the question. Whether it is prudent to buy contracts to preserve future sales or to leave positions uncovered and enjoy gold's meteoric rise. To rise, to raise, to take hazards, no more than by taking risk, the capital dilution, or the shareholders' wrath. Ladies and gentlemen, welcome to today's special event. No, it's not me reciting Hamlet the Gold Bugs edition. Instead, I have a guest with me who will discuss with me, you guessed it, whether mining companies should hedge or not. Joining me today is Sean Russo, founder and principal of Noah's Rule, a Sydney-based risk management and financial solutions company. Some of you may be familiar with Sean as he's quite visible from attending conferences and featuring in different platforms, providing his insights. In the 2024 Australian Gold Conference last month, Sean reached out to me and we decided to do this discussion. Sean, how are you doing?
Yeah, good, thanks. I love that quote. Very, very well done, Brian. Great introduction. Nice to see you.
Because I remember that you and Hedley did a very good Titanic, I'd say a rendition with a slightly different theme. So I thought I might copy that for this one. And I'm glad you like it. And I hope everyone else also does the same.
Yeah, no, very good. Yeah, and it's a good question, right? It's a question we deal with a lot, to hedge or not to hedge. And it depends. It depends on so many things, but we'll get into that.
Yeah, especially given what's happened with gold overnight. It's gone up to another record high, $26.60 an ounce. And Australian dollar gold is about 3,860. Some producers actually hedge and some have taken out their hedges. And I know that shareholders are very much divided on this. So I thought, what better way to do it and to have Sean with me on board to talk about your perspective. So to kick everything off, Sean, can you tell us how your journey brought you to establish Noah's Rule?
Yeah, sure. In 1984, I answered an ad in the newspaper. That's when the way jobs used to get done back then in the Financial Review, to be a trainee gold dealer at Rothschild. And I didn't qualify for any of the criteria they set for the ad, but it sounded like a really exciting thing to do, so I applied. I still don't have all the qualifications required to meet the job, but I got it. I spent 20 years at Rothschild, and during that time I was very largely from 84 to 2004 was very much involved in mine financing and use of hedging. And that was a very different environment back then, Brian. And in 1987, we made a high of 720 Australian, 510 Aussie. And then we proceeded to decline for the next 15, 16 years. So hedging was very much on the landscape, and Rothschild was right in the middle of all that. So, really I cut my teeth. I met lots of people in mining. But in the late 90s, as gold prices got very low, people started to use mining to keep mines open that should have been shut. And there were some very bad things happening, and people were calling it hedging, but it really wasn't hedging. It was kind of job salvation rather than, it was in the best interest of management. It certainly wasn't in the best interest of shareholders necessarily, and long-term preservation of assets. And I remember thinking someone should help these people. They come and ask us questions at the bank and whatever, but I was having too much fun at Rothschild to look at selling. There were some independent people advising companies, and the advice wasn't very good. So in 2004, when Rothschild got out of the business, I decided that it was the time to set up an independent voice to help mining companies sit down and ask the question, to hedge or not to hedge. If you decide to hedge, how to hedge, who with, in what amount, for what duration, and all those other questions. And we've got a presentation that we do with clients today that's called the hedging. The answers remain the same. The questions remain the same. The answers keep on changing. And that's really what we're all about, helping our clients look at their individual circumstances and the current market circumstances and trying to find if there's a match or, what you do and how you do it.
Right. So what fascinates you about commodities and the foreign currency markets? Is that where your key focus is, or is there something else? But definitely very interested in precious metals and your story behind it.
Yeah, look, I love the financial markets. I love the history of gold. I love the financial history. I like I think everything comes back to that quote that history doesn't repeat, but it rhymes. And, financial markets are just a reflection of individual behavior and greed and fear and, boom and bust. And I think that's fantastic. And I think at the middle of all of that is gold, which has been money for 5,000 years. And I'm a great believer, therefore, in ratios. And if you've seen me speak at conferences, I speak about the Dow Gold ratio and things like that, because that's really how you should measure the long-term value of anything, is relative to gold, in my view. You could do it relative to property. You could do it relative to some other kind of scarce resource like coastal property or something like that, But really, gold is just a great measure, and it's totally understood right around the world. I mean, there's nowhere you go in the world that people don't think about or know about gold in some way, except probably in Australia, where the vast majority of the population are incredibly ignorant of it. We've just had it too good for too long. People who've lived in war-ravaged parts of the world in the last couple of centuries, or people with despots running the country that erode currencies much faster than our democratic system does, probably have more of an understanding. But yeah, the whole gold is the intersection of everything to do with kind of human beings' belief in various financial systems or government systems and the financial markets, and it's just a great place to be. Mining gold is just one aspect of that, clearly, one challenge, but it is interesting. Gold miners are essentially digging money out of the ground. You spend the money of the day to buy the money of the last centuries, and at different times that's very profitable or not very profitable, depending on what's happening in the broader world. Great. I love it. Never dull, right? Never dull.
Actually, I like the fact that you're also quite into looking at market ratios and using those ratios to help guide your decisions and also your advice. And we'll definitely have the opportunity to talk about that. One thing that I also want to cover especially is that your business provides, among other things, risk management, capital market solutions, and advising market transactions. Now, I want to delve deeper in the risk management side of things. I'm aware that Noah's Rule guides mining companies on setting fixed price commodity sales, otherwise known as hedging.
Yep.
And this topic of hedging has gained more media attention recently as the price of gold continues to break new records, leading to some companies like Capricorn Metals and Regis Resources closing their hedge positions and paying to do so. Now, what's your take on hedging? Firstly, because I know that there's a lot of divisive debate about it, and some investors love companies that have some hedging, while others are saying, I don't want to invest in these companies because they hedge. Their profitability going forward is not going to be as good. What's your take on it?
Look, clearly we think that it's a tool that mining companies can use, and it's quite a unique tool. There's not many industries in the world where you can borrow the very commodity that you produce. So, if you look at prepays and gold loans and things like that, the idea that you can actually borrow in the very unit of what you produce is quite extraordinarily rare, right? So I think that's interesting. But I think the best way to think about hedging, some people don't like this analogy, but I think it works very well, is hedging is like a gun, okay? Some people don't like guns. Some people love guns. But the fact of the matter is, if you don't like guns or you don't know how to use them, then they should be locked in a cabinet and you should go nowhere near them, because you'll likely hurt yourself or somebody else. And I actually, as a quick aside, I saw someone who works in an emergency room of a hospital, and he gave the 5 major reasons that people come into emergency rooms and things you shouldn't do. And one of them was have a gun in your house, because the number of people who are injured by their own weapons is just enormous, right? So, but I think you can also feed your family with a gun. If you're in the wilderness, you can defend your family, or you can blow your brains out, right? It's just a tool, and it's how you use it and which direction you point it. And hedging is exactly the same. People who don't know how to use it, who buy the product from the bank, just accept whatever it is that the bank gives them in order to get debt or whatever else, without thinking through, is that right in this circumstance? And it might have been right for a company 5 years ago in a bear market. It's not right in a bull market. But if they don't think about that, you can easily blow your brains out with hedging. You can also create incredibly robust companies that deliver fantastic returns to shareholders through hedging. And you can do that in a rising price environment. And Capricorn Metals is the perfect example of that. Yes, Brian, they're spending money to buy hedging back now. And I think that's because they left some of their hedging on for too long. We won't get into the detail, but when they originally did that hedging, they did that hedging to do project financing. They did project financing with Macquarie, and my recollection is at the time the share price was somewhere between 25 and 40 cents a share. Now, I've seen on a recent Money of Mines podcast, for example, some fund managers and brokers that say all mines should be developed with equity only. They shouldn't use debt. Debt's bad. Hedging's bad. Well, any broker's going to say that because they get a fee to raise the equity. If Capricorn had funded its original Carl Winder project fully with equity, it would have had to double or triple the number of shares on issue at somewhere between 25 and 40 cents. Which would mean it has 2 to 3 times as many shares on issue today, which means its share price would arguably be a half to a third of what it is for the same market cap. So when you criticise today with the perfect benefit of hindsight, decisions that management made in the past about hedging, and you say, look at all the money you lost, that loss measured with hindsight has to be measured against the value of dilution avoided. So we're talking here specifically about hedging in relation to finance, right? So not just hedging that some management company did because they thought, oh, the price looked high, let's lock some in. But when I want to build a mine and develop that mine and borrow money and take on debt, hedging with debt as an alternative to equity, hedging is all about minimizing equity dilution and therefore more gold per share, more earnings per share. That's where we get the share price kick. And so Capricorn, who have probably at the moment, by virtue of when they did their hedging and rolling it and not delivering into it when it fell due, have the worst hedge book in Australia in terms of the lowest gold price of any company and arguably far too much hedging relative to the debt they have left. It has not impeded their capacity to increase because the number of shares in issue is tight. They have a tight capital structure, management team, have a great reputation, premium for their capacity to deliver. Hedging hasn't been an obstacle. So, but hedging is at the core of their success because the gearing early on and avoiding that equity dilution is one of the most significant reasons they have such a fantastic share price today. It's plain and simple. So I think that's a good example of hedging and not necessarily done as well as you might. Again, I'm using hindsight, but we said at the time when they did their project financing, we didn't understand why they needed to do as much hedging as they did, but that's between them and the bank. But nonetheless, done incredibly well in a rising price environment. So I think that's great. You see companies that fail, and there's been examples of that in recent time. If the mine fails, if bank lends you money and you hedge, and then when you build a mine, you just don't produce anywhere near as much gold as the spreadsheet, the financial model said that you would, then your mine's going to fail to perform. Your share price is going to go poorly, and you may collapse under the weight of that debt. And hedging won't help in a rising price environment. But the bank, when they did that original model, if the gold price was where it is today and the mine was making the gold at the cost they thought they would, the hedging will be a cost, but it shouldn't be an obstacle to success, and you would have avoided dilution. So I think there's other issues with that. So, I think Calidus, I would say to you, is a failure of mining and understanding the geology and the capacity to extract much more than it's a failure of financing. And that was true of Gascoigne as well.
Yeah, I think a lot of people probably do confuse the two, and it's easy to conflate because their end point when they're looking at whether something is good or not is whether their investment, let alone the share price, what they really care about is what they pay for and how much they are able to sell for, sell out later on. And not very few people can get the timing right, and therefore to them every little bit, every little feature that helps keep the dilution minimal while maximizing the cash flow counts to them. But I think we've had a conversation 2 weeks ago where between you and I, just personally, it's almost like having the cake and eating it in that sense.
Yeah, and look, I mean, we had a client in North America that would only become well known to Australian clients when St Barbara took it over, a company called Atlantic. We helped
Yes.
them do a financing. They had a tiny market capitalisation, and they didn't want to raise the equity required to build the mine. We spent a year and a half negotiating with Macquarie, a highly hedged transaction management, with their eyes wide open, said we want to hedge as much as we can because we want to minimize the equity dilution, because a lot of the shareholders have a significant stake. We're owners in this business. We end up hedging about 70 to 75% of the gold for the first 4 years. I would not recommend that
Wow.
ordinarily, but that's what we did because we got 100% of the hard capital required to build that mine. From the time they announced that hedged transaction to when they got taken over by St Barbara, the GDXJ went down, the Canadian gold price went up, the hedging was out of the money, so it cost the company money. The share price went up 11 times. It was an 11 bagger from announcing the project financing to getting taken out by St Barbara. Now, you might argue St Barbara paid a bit too much, but even if they only paid 7 times, not 11 times, all of the success of that company was in the successful financing and avoidance of dilution. And they did that in a period where the peer group went down, all right? So it was about understanding the value of the asset in the ground and the share price, Brian, and this is, I think, is a very important point for where we are right now. When Atlantic went to the financing, their share price in no way reflected the inherent value of their in-ground inventory at the prevailing gold price. So if you can sell gold into the future at the current price, that would reflect a much higher share value. If someone will let you lock that in, if someone with the skill of an understanding of a bank that has experts value that mine and says, I'm going to let you sell the equivalent of 3 years worth of production today at this price, then a shareholder says, well, this share's trading at 20 cents, but if I value it at that gold price, the share price should be 70 or 80 cents or $1. Like, it makes no sense, the NPV of the project at that price. Then you should forward sell gold at preference to selling the shares. I mean, it just makes perfect sense. In the same way, if someone will give you a 5% royalty on future production and give you the equivalent today in cash of your market cap, if you can give up 5% of future revenues or double your shares on issue, you can do the maths and figure out which one of those makes more sense. And if your share price doesn't reflect reality and the hedging does, if you're comfortable with your capacity to mine and produce, then that's going to make sense. So Capricorn's a good example of that. Atlantic's a good example of that. There are some bad examples where people didn't have the capacity to mine and build, or the assessment of the asset was wrong. Yeah, I mean, both ways. But that doesn't mean hedging. That's a gun, right? That's the same analogy.
It's interesting you brought up Atlantic Gold and St. Barbara because back when I started investing in gold stocks in a big way in 2013, the price of gold, as you mentioned, actually fell significantly, fell probably about 30% in the space of 2012 to 2014.
Yeah.
And most of these companies had a modest amount of hedging. St. Barbara had a massive amount of debt, $350 million, and the share price fell to as little as 7 cents, and I think the market cap was $35 million. And I think they had some hedging, which probably prevented them from going under. Furthermore, the $350 million of debt was due in 2018, so there was plenty of time for them to enjoy a recovery in gold. Now, there were two other companies that I thought were also worth mentioning at that time, Perseus Mining and Regis Resources, and they hedged. I think Perseus Mining had the best hedging arrangement among the Australian listed gold producers. I think they hedged at about $1,600 an ounce, and they only just launched the Edikan mine. And if it wasn't for the hedging, the gold price fell to $1,300. And also almost 1,200 and 1,200 and even 1,050 by the end of 2015. They would have gone under. Perseus Mining nowadays is a $3 billion company, and hedging is probably what saved them through the tough times. But we've been having a great time with gold the last 5 years. Now, Sean, how do you specifically help these companies in determining when is a good time to hedge and when is not a good time to hedge?
Sure. Well, so we help Perseus arrange that that hedging and that debt with Macquarie and
Thank
Credit
you.
Suisse back in the day. And look, so partly the timing, one of the issues in this whole hedge or not to hedge and what product, part of the issue is that you're not really that much in control of the timing in the sense of you get your studies done, you're ready to go, you're finally bank ready, right? Yeah, so you're in the vicinity of being bankable. If the prevailing price is not attractive, it's very tough for mining companies to say to the market, oh, we're going to go back and explore and wait for the price to get better, because if you're going to be nearly going to be a producer to explorer, you're going to get your share price is going to be sold off. So one of the problems is sometimes people, by the time they get all that done, the share price is not favourable that they proceed. Perseus were quite fortunate in that over the time that they were negotiating with the bank, the gold price was going higher and higher. But the very interesting thing with Perseus is we pushed very hard with the bank to reduce the level of hedging because we were saying at the time in 2011 that the hedging's too big relative to the debt. And it took a long time to work through the bank and get comfortable with that. And we said, look, we're happy to let them hedge that much, but the company should only hedge this much. They did. The price went higher. A few issues as the mine started, a little bit delayed. They did some more hedging higher up. So they ended up having a good hedge book, as you say, when it fell. They did, Regis did. Another great example was Saracen. Saracen had hedging when it fell. I mean, at one point, Saracen's hedge book was in the money as much as the market capitalization of the company. I mean,
Oh,
the
wow.
value of the hedge book was the market cap, and then they had debt. Now, the big thing with a company like Perseus that you just have to talk about in 2013, 2014 is they didn't have to issue any shares because of the hedging, right? So companies that had debt and no hedging, like Troy and Kingsgate and a raft of American companies, a lot of them had to issue equity to get by. And so that was very, very destructive to their capital structure because very low share prices, big discounts, they really blew up their capital structures. Evolution's another great example of a company that hedging before the fall. They had the Edna May hedge, which they delivered into. So those companies, so it's interesting. So when people are critical today, like Perseus has hedging today. No one criticizes Perseus because they're outperforming the share price. They're outperforming most of their peers. They behave like an unhedged company, but they have hedging. So that's fantastic because you've got that security of having some level of future certainty, whatever happens, because we know how quickly things can change. But you've got a gold share price that's outperforming the share price and paying a dividend. What's not to love about Perseus? So, who are still a client to this day. We love the way they behave, and you look at what they have. So they deliver the same type of returns as companies that are aggressively unhedged and have a lot more risk. So, why would you not choose them? But I think the really big thing that I look at today is if you start to criticize companies as brokers have in recent times that have hedging books, and every quarter they go, oh, look how much money they lost last quarter, look at how much they gave up. You're criticizing the people that actually survived in some cases from 2010, 11 through 13 and 14. And the reason they survived is hedging, and now you're criticizing them for the hedging that they have. What about the peers that all went broke or blew up their capital structures in that interim period? So there's a survivorship bias that you're criticizing the companies that survived and have gone on to do good things, even though hedging was one of the tools that they used, but they used sensibly to defend themselves and to feed themselves during that lean gold winter, right? So it is quite funny. But brokers always will criticise hedging because the alternative to hedging and sensibly run companies is raising equity all the time, like they do in North America, and the brokers obviously love that. So you're never going to hear brokers, I think, really, or very rarely. I'm being a bit, but they've got a vested interest in not being too keen on debt and hedging if equity is the alternative, right? But yeah, so look, there's Northern Star. Early hedging in their early days, still hedge today. I mean, some companies it's in their DNA, and it's about sensible risk management. And as long as you've got rules around it, the policy, your hedging policy is like your gun cabinet. When do you take it out? How do you use it? What do you do? When do you sort of lock it up? When that's really the thing, and how you watch how companies modify their behavior over time.
Excellent. And I think to wrap up before we go. I don't want us to appear like where for example, you're talking your book or that we're completely sold on to hedging, because I know that we would like to have both sides of the story.
Absolutely.
Now, yeah. So there are people who would prefer companies not to hedge, but they don't want they also don't want the company to dilute their capital heavily. Can you see other alternatives to getting companies to have sufficient funding, but not exposing them significantly to the downside of a commodities cycle?
Yeah, absolutely. So right at the moment, I mean, they're not always affordable, but right at the moment, because the gold price has gone up so significantly in such a short period of time, and because the sentiment, not necessarily reflected in gold prices, but reflected in gold option prices, is so bullish, that put options are relatively cheap, Brian. So you can buy meaningful strikes at modest premiums. Now, what do I mean by meaningful strikes and modest premiums? Meaningful strikes are a strike price that you can underwrite with the put that is a substantial premium over your all-in sustaining cost. So you've got an all-in sustaining cost of 2,100 and you can buy 3,000 puts or 3,200 puts to be able to secure that type of guaranteed margin to support your capacity to borrow money and minimize dilution. If you can go out and only spend $50 to $100 an ounce, so modest premiums on options, and buy a meaningful strike to lock in, and that supports debt, then that's great. Because one of the things you've got to be, again, to go back to hedge or not to hedge, then how to hedge question. The reality is when we talk about hedging, everyone just thinks you're talking about forward sales or you're talking about collars where you sell one call to buy one put. But hedging is buying puts. Hedging is doing ratio collars where you sell one call to buy two puts, where your commitment is half as much as your cover. Puts are obviously risk management nirvana in the sense of I can spend an amount of money and a bank might lend me the money to buy them, so I don't have to spend any money up front, underwrite a minimum price, keep all the upside, and be certain enough I'm going to have in any circumstance, I'm going to have income, and that allows me to borrow and minimize dilution. That's fantastic. So at the moment, that's very possible. And when we present that to companies and suggest that's the best way to go, people go, well, this looks too good to be true. Or why don't people always do this? If this is such a good idea, Noah's rule, why doesn't everyone do this? And you go, well, it's not too good to be true. It's rare because the circumstances that prevail to allow this to happen are rare. You know, puts were cheap in 2011-12. They were cheap in 2007-8. That's the last two windows I can remember where you could do a project financing where you could say to the lender, yes, I want to borrow your money, but lend me a bit more and let me buy puts. I don't want to do any of those forward sale things at the moment because I'm pre-production or whatever. So that's certainly possible, and you'll see that. Alkane just announced they've underwritten all their production at 3,000. That feels like a long way away right now, but to know you're never going to sell for less than 3,000 for the next 3 years allows a company to plan differently, to maybe look at different cutoff prices and things in the way they think, because they've got total security. So, and we'll see more put option transactions, I think, in coming times. We've done a number of put option transactions in recent times for clients. So that's certainly the product choice. That's a great question. The other thing, just to be clear on this either way, we have sat with clients in the past and advised on financings, and there was debt and hedging, and there was debt without hedging, and the debt was more expensive and it had a royalty and it had other things in it. And we looked at it and we said to the client, we believe you have two choices. Take the expensive debt with the royalty and no hedging, or go back to exploring, because the level of hedging the lender requires is simply too great for your asset in the current environment, whatever. And that client chose that other lender and went forward and was very successful. So, you know, hedging was just not appropriate to their circumstances. So, yeah, I mean, and again, that was our job, was to help them try and understand the risks, and we thought the risks of hedging were too high. That's not the first time that we've done that. Right at the moment, you could do very modest hedging and get very good financing, or you could use puts. So we think we'll see more of that going forward. The thing I would be most suspicious of at the moment, if I was a shareholder and I'm a little bit cynical about hedging, would be any company that announces they've just done some hedging, and if you ask them why, they go, well, the price is high. Like that's like going out with a gun and shooting tin cans for fun. Like they're not using it appropriately, and maybe someone might get hurt, right? Like every time when someone, what is the reason for doing it? To avoid dilution for financing, to underwrite a cutback. We wanted to create certainty, Brian, to ensure that we can keep paying our dividend for the next 2 years. We've actually just done some hedging here, and we're going to lock in a special dividend related to that. You know, there's a whole other range that I think that we can see and would make sense. But the minute a company tells you that they've done it because they deem the price to be high, they're just, six shooters. That's not their job, and that's not the way they should be doing it. So that's always the first thing that I'm listening for or looking for in any announcements. There's got to be a better reason than the price is high.
Excellent.
It was high at 3,000.
True. Actually, there are times even as I was talking to you before we recorded at 38.60, I'm also a little bit cautious as to whether gold's gotten ahead of itself. So Sean, how I know that you service mainly companies. So how would ordinary shareholders be able to benefit from your insights or any services you've got?
Look, I mean, really, our service is very bespoke, and the recommendations and the reports that we write are really only for our paying clients. So, I mean, I guess things like this, when we speak at conferences, if anyone has any particular question and is willing to pick up the phone and call us or hit me on LinkedIn or send us an email and says, I heard this person say that and I didn't understand it, or could you explain it to me? I'd be happy to take the time to do that for individual investors, because I'm maybe going to hear about something that someone said that I didn't hear, and I'm always keen to understand what's going on in that hedging market and what companies are saying. So there's something in it for me as well. So absolutely happy for somebody. I just had breakfast with a couple of fund managers this morning who exactly just said, look, we have people come in all the time, and they start talking about hedging, and we're convinced they don't understand, but they're going to do project financing. Can we send them your way? Yeah, sure. Happy to have a chat, see if they would work. So I think that's really, I would hope that what I would say, without wanting to sound too brash, is if you see that someone has hedging and you're a little bit unsure about hedging, ask them if they have an advisor. I think, we have a very good track record with our clients of long-term success. I know there are some investment advisors that if they ask about hedging and the people say we work with no rule, they go, that's fine. Like, we get their philosophy, we understand the way they work. But I think the most important thing is for people to ask of the companies, and just remember this conversation, why did you do the hedging? What were the reasons for doing the hedging? And I think, we talked about what the sound reasons for doing the hedging are, and be aware of that. We thought the price was high. But I think that's it. But other than that, yeah, I mean, there's not really a product or whatever that we have that's out there. Yeah, I mean, every now and then we might post something on LinkedIn, but otherwise, really, our clients pay us to help them look at these things, and to the extent we think there's something interesting, we try and present it to our clients and not the other producers that aren't working with us.
Excellent. Well, Sean, thanks a lot for your time. And what I might do is perhaps put your LinkedIn link on that web page, or the updates to my readers. And I'm sure we'll have you back, because all these insights that you provide, I'm sure there'll be plenty more that you'll be able to share. So, ladies and gentlemen, I'm really glad that you joined us for this video, and we'd like to thank Sean for his time. And we also hope that if you have any questions, you can also send it to me, and I could also pass it to Sean if is anything stock specific that I could even filter through before sending it to Sean. So, ladies and gentlemen, thank you for your time, and Sean, thank you very much, and God bless.
Brian, thank you. Really, really good fun. Oh, one last thing very quickly. The last thing of yours that I read, very insightful in terms of talking about energy and gold and what's that doing for margins. And that's something we're really concentrating our clients. And I would say going forward, looking for companies that are hedging their fuel, as well as if they're hedging gold, they're also hedging their fuel, is something I'd look out for, because obviously these operating margins, that's one of the reasons that companies are doing so well at the moment. And we've got oil going down and gold going up at a very high ratio. That just seems to be something to me that historically will not necessarily last. So I think companies that are paying attention that are companies you should be paying attention to.
Oh, excellent. That could probably be a thing that we could talk about in the next discussion.
Yeah, great.
That we have.
Fantastic.
All right. Thanks
Cheers,
very
Brian.
much for that.
Thanks a lot. Bye.